Well, hello and good morning, everyone, and welcome to the Experian Quarterly Business Credit Review for Q4 2017. I'm Gary Stockton, and before I introduce our speakers, I just want to remind you to take the opportunity to engage our experts. You can use the question and answer box in the WebEx toolbar, and we'll try to answer as many questions as possible at the end of today's program. If you would like to download the slides from today's program ahead of time, follow along with us. I know many of you request the slides up front, so we'll leave this link up here for a few minutes. During today's webinar, we're going to be discussing the key findings in the most recent Experian Moody's Analytics Main Street report for Q4 2017. Our speakers today will be Brody Odom from Experian, Derek G. McCrank from Moody's Analytics, and Krista Rideth, also from Moody's. Brody Odom leads a team of statistical consultants while remaining an active strategic statistical consultant for commercial data sciences within Experian. He has 18-plus years of experience in disciplines including analytics, database development, prospecting. In his current role, Brody provides the marketing and sales organizations with customized analytics support, and prior to joining Experian, he worked at Citi Cards and Citi Mortgage as the consumer credit risk analytical consultant. Derek McCrank is an associate economist at Moody's Analytics and a member of the Credit Analytics Group in Westchester, Pennsylvania. Derek works on building stress testing models of consumer loan performance for a number of consulting projects. He has a bachelor's degree in economics from the University of Wisconsin-Whitewater. And Krista Rideth is a senior director at Moody's Analytics, where he manages a team of economists focused on consumer credit modeling and analysis for banks, investors, utilities, and other financial institutions. He provides a regular commentary to clients and the media on the state of consumer and credit markets and small business. He received a PhD and master's in economics from Johns Hopkins University for his work on income inequality and technological change. And Chris graduated from the Honors College at Michigan State University with a bachelor's degree in economics. And without further ado, I would like to turn things over to Chris from Moody's.
All right, well, thank you very much, Gary, and a warm welcome to everyone joining us here today. So there's a lot going on with businesses and small business credit in particular that we are very excited to share with you today. So I'm going to start things off with an overview of the general economic environment, more or less just to set the stage or the tone of what's going on, and then what I'll do is pass the session over to my colleague, Derek McCrank, who's going to go into specific small business credit trends and talk about some of the things that we're seeing in terms of credit volume as well as performance. So let's turn to the economy. So by almost every measure, the economy continues to perform well. The current expansion is going on nearly 9 years. In June, it will be exactly 9 years old. And that makes this the second longest expansion in U.S. history. The longest expansion was 10 years back in the 90s, from 91 to 2001. And by every indication, we have enough gas in the engine, let's say, to get to that mark and set a new record with the current expansion. So everything more or less seems to be working together when it comes to the economy. We are seeing growth, we are seeing improvements in the labor market, and things are definitely continue to move in the right direction, at least for the short term. And one way to assess this or to understand where things might be headed in the short term is really to focus on consumers. Consumers are responsible for about 2/3 of the economic activity in the country through their consumption. And so understanding what's going on with consumers and how they're feeling about the economy can give us some indication of where things might be headed, again, if we're really focused on the short term here. So if we survey consumers, what we can see in the data is that they are very confident, they're very optimistic about the economic prospects. They're telling any variety of surveying organizations, whether it's the Conference Board, the University of Michigan, or even the Moody's Analytics survey, what they're telling all of these different questionnaires is that they are feeling confident in their current labor market prospects. They are feeling confident in the direction of the economy. They continue to experience and expect growth going forward. So confidence is up, as you can see in the chart here. We look at the purple line, that's consumer optimism as measured by the Conference Board. You can see that that purple line is as high as it's been in the history of this series, going all the way back to 2000, right? So we have to go back to the tech boom to get a level of consumer confidence that's as high as it is today. So that is definitely a testament of the improvements that the economy has experienced throughout the expansion. As the economy has continued to dig out from the Great Recession, consumers have been feeling more and more confident in the prospects of the country. Small business owners are also particularly enthusiastic as well, and you can see that on the chart given by the blue line. This is a survey conducted by the NFIB of small business owners. And here again, we see that confidence is at a very high level. We can see it's consistent with the levels of confidence that we had during the housing boom back in 2003, 2004. It's quite high. And small businesses really saw a big jump in confidence right around election time, right? If we go back to the end of 2016, you can see there's quite a jump in that confidence series right around the time of the last elections, presidential and congressional elections. So during those elections, we'll recall there were a lot of promises made for tax cuts and easier regulation. And effectively, that's what many small business owners have received, right? We have had a tax cut program that now has passed in December, and enforcement of regulations has been a little bit more lax, perhaps, than certainly what we saw in the previous administration. So small businesses continue to express a lot of optimism when it comes to the country, and as we look forward over, say, the next 2 or 3 quarters, we'd expect this optimism to translate into some continued momentum when it comes to growth. But if we want to dig a little deeper and really understand why consumers in particular may be confident, we can do an analysis of the labor market and see very clearly that jobs are certainly a big portion of that confidence. And in particular, the improvements in the labor market over the last 8-9 years are very much consistent with the increases in confidence that we're seeing. So the unemployment rate is now at a low 4.1%, very low level. That again, we'd have to go back to the tech boom in 2000, 2001 to see a level as low as it is today. It continues to make progress downward, right? So that we've been steadily declining from that 10% peak, and so things are clearly in the right direction. In 2017, we added 2.1 million jobs to the economy, which translates into an average of around 175,000 per month. We need to add about 80,000 jobs a month just to keep up with population growth. So new college graduates, new high school graduates, new immigrants to the country. We need at least 80,000 jobs. So at 175, right, we are well in excess of what is needed just to keep up with population growth. And as a result, we've been able to pull more and more people off of the sidelines and back into the labor market. And as a result of that, you can see that broader measures of underemployment, such as the U6, which is another measure that the Bureau of Labor Statistics produces, which includes not only folks who are unemployed, but those who are quote unquote marginally attached, or individuals who perhaps have looked for a job in the past, but they gave up looking a while ago. More and more of those individuals are coming back into the labor market, and as a result of that, you can see that that U6 rate is declining as well. It's back down to an 8% level, which is consistent with what it was prior to the recession, and it keeps falling. So labor market is clearly moving in the right direction when it comes to creating jobs, providing new opportunities, not only for new graduates, but also for those who may have given up work, lost some hope in the past. We can see that they are coming back in, they are seeing opportunities. So again, that definitely is a boost for consumer confidence in the short term. Looking a little bit farther ahead, we can see that at present we have over 6 million job openings in the country. So employers continue to demand workers, demand labor. They see a lot of opportunities for their goods and services. And so this, again, translates into confidence on the part of consumers who maybe have had to take jobs in the past just to pay the bills. With a stronger labor market, now they are able actually to seek out employment that maybe provides a little bit higher income, better benefits, and ultimately a better match with their skills, with their preferences, and with their job satisfaction ultimately. So that has translated into some increase in the quit rate, as you can see on the chart here as well. And that then is absolutely a positive factor in terms of our economic outlook. A better, more robust labor market will clearly lead to some higher productivity gains going forward. So we're quite optimistic when it comes to labor market altogether, and our expectation is that the labor market actually will only continue to improve over the next few quarters, right? If we consider that we have those 6 million job openings and businesses continue to see demand, and on top of that, we've just passed a pretty substantial set of tax cuts, as well as some additional fiscal spending, so additional stimulus is being added to the economy. At least in the short term, we would expect that the unemployment rate would continue to fall, right? The demand for labor will be so strong that we'll continue to see more and more jobs being filled by those on the sidelines. And our expectation is that the unemployment rate could actually fall as low as 3.6 by, say, 2019, right? There's enough momentum in the economy to get to that very low level of unemployment. And as a result of that, what we would expect is that wages would ultimately have to start to rise. And this again will be a boost to the economy in the short term, as higher wages will translate into more spending by households, which will benefit businesses of all sizes, both large and small. Right, so you can see on the chart here that wage growth or employment compensation has been somewhat sluggish throughout the recovery period. It has been certainly a cause of concern. In more recent quarters, though, we have seen a little bit of a tick up with the employment compensation index rising about 2.5% as of our latest read, and we are expecting that then to rise to a 3% growth rate as the labor market tightens up even further. So I'll end my comments here with just one risk to the outlook. As I mentioned, if we're thinking about a 2-year horizon, things do look quite favorable. There is a lot of stimulus already in the economy already that is going to push it forward for these coming quarters. However, the most important risk that we can identify at the moment has to be interest rates, right? There is a risk that interest rates will spike over the next couple of years, and certainly that would not only increase the cost of borrowing for households and businesses alike, it would ultimately then, or could potentially then, draw the economy into recession as some of that activity that I mentioned slows down and ultimately could turn negative. So the real risk here is that given all the stimulus we have put on in the economy, the Fed may have to react at some point to some fears of overheating, right? There is a concern that inflation might pick up in the future as this stimulus continues to work its way through the economy, as the labor market does tighten up and wages do start to rise. That could put a lot of pressure on prices overall. And in that case, the Fed would have to intervene, start to increase the Fed funds rate more aggressively and take other monetary tightening actions. Now, most investors, most households, most businesses are aware that interest rates are going to rise, and they expect that these interest rates will rise rather gradually over the next few years. And if they are gradual, that should be quite digestible. The real risk, though, is that at some point the Fed falls behind and has to catch up to some of the activity that's going on in the economy, and we see some rate shocks or some very sudden increase in interest rate. The other risk here is that global investors so far really haven't fully appreciated the risk that rates could rise. If you look at their market-implied forward-looking views, as you can see in the chart here, they still have a relatively tame outlook for interest rates over the next couple of years. And so there is a bit of a disconnect. Our expectation is that the investors are going to catch up relatively soon, and we won't experience the type of shocks that I'm describing here, but there is certainly a risk that things could get out of hand at some point. However, with all that said, our models still project a relatively low probability of recession, at least over the next 12 to 24 months. And so from that perspective, we're feeling quite confident in the prospects of consumers as well as small businesses. So with that, I will turn the presentation over to Derek to talk us through a little bit of the challenges and some of the opportunities that we see within small business credit. All right, Derek?
All right, thanks, Chris. So I always like to start out by saying I think that the partnership that we at Moody's have with Experian has the potential to create a lot of value in the small business credit space. And one of the ways that it does this is through the combination of Experian's unique data set, where we can see in any given quarter approximately 7 million small businesses, combined with the forecasting capabilities that we at Moody's have. And today, for the first time, we're going to be able to show you a forecast of small business credit and our expectation of that for the future, which is something I've been excited for a couple of quarters now and look forward to sharing with you in a few minutes. What I'm going to start with, though, is a review of what happened with small business credit in the fourth quarter. So in the fourth quarter, it looked like credit conditions were fairly stable. If you look at the dark blue line, which indicates delinquencies that are 1 to 30 days past due, which is the earliest of the delinquency stage buckets, we did see a sizable uptick. Given that it was paired with increases in the 60 and 90-day buckets, it's something to watch going forward, but it isn't necessarily something to worry about, as a 40 basis point change coming off of what was in the third quarter the lowest value that we've seen for those early stage delinquencies. It isn't a worry yet. It could be noise. It isn't necessarily an indication that we're seeing a change in small business credit. Looking at the bankruptcy rate, we saw an uptick here as well. So when you consider that there was an uptick in those early stage delinquencies, an uptick in bankruptcies, again, you might be thinking, what's happening here? But again, I say, don't worry about it. The bankruptcy rate for small business credit is coming off of its lowest levels in years, which was reached back in the first quarter of 2017. This isn't something to worry about. It's a natural churn returning to the small business market. So in the last couple of years, we've seen that very few businesses were willing to take more risks and expand. But now we're beginning to see that businesses are possibly taking some of those risks again, and we might be getting back to a bit of a more dynamic market for small business credit, which should be a little healthier over the long term, as it should lead to more formations as well. So getting into the start of formations, I want to show you balances. So in the fourth quarter, we saw a fairly sizable increase in total balances. You can see the blue line shown on the screen here. Balances rose almost 12% in the fourth quarter, which is a little bit crazy. But when you look at the average balances, you see that they only rose about 6%. So it spurs the question, why do we have this disconnect? Why all of a sudden has average balance growth crossed total balances? And to answer that, we look to the total number of businesses in the data set. So in the fourth quarter, we saw that some new businesses were entering the market. And as can be seen in the BLS establishments data, business formations have been on an upward trend after bottoming in the second quarter of last year. But in the third quarter, they recovered, and it looks like a similar story is unfolding in the fourth quarter, where in the Experian data, we saw roughly 4% growth in the number of businesses that were accessing credit. Now, since Experian is a rating agency, it isn't necessarily the total number of small businesses increased by 4%. That isn't what I'm saying. What I'm saying is 4%, the number of businesses that were accessing credit in the fourth quarter increased by 4%. So some of those are going to be new. Some of those can be returning to credit markets. Either way, we're seeing an increased appetite for credit from small businesses, whether they be new, whether they be established. Demand for credit is present in the small business market. And part of this can also be seen in the utilization rate, where we see a downward trend that's been established for 2017, and that was present throughout the year. So as businesses were accessing credit, they were increasing their available lines, whether it be credit cards, other forms of revolving credit that could be accessed as needed. And one of the themes that I talked about last year a lot was businesses sitting on their hands, waiting to see what was going to happen. Well, in the fourth quarter, as was seen in Chris's earlier slide, talking about confidence, businesses got some of what they were looking for in a tax reform package, which looks set to increase demand for small business credit further. Looking now regionally, I'm going to focus on the West here because it leads into my next slide nicely. So we saw the year-over-year change among small businesses in the West for the severe delinquency category, or 90 days past due. The severe delinquency category was the least changed among the 4 Census Bureau regions. So in the West, severe delinquencies were down about 6 basis points, whereas in the other regions, severe delinquency fell faster. And the reason I wanted to focus on the West is because of this slide. So I mentioned at the very beginning that I would be showing you forecasts of what's going to be happening with small business credit. So the forecast that I'm showing you today is severe delinquency among retail businesses in the West. So this region, the dark blue region here, is what's defined as the West. And you see the dashed blue line is the Moody's Analytics baseline scenario, the scenario that is considered most likely given current economic conditions. And looking at this, you see throughout the rest of 2018, small business delinquencies in retail credit for businesses in the West are forecast to decline as they have been for the last couple of years. Then in the solid blue line, we have an upside scenario. So if economic conditions are more positive than we expect them to be, say tax reform has outsized effects or whatever the situation may be that drives a stronger economy in the U.S., we would expect that small business delinquencies for retailers out West would be lower than in our baseline scenario. And then we have three additional alternative scenarios shown, one in pink, one in sort of a magenta, and one in gold. And the gold is our protracted slump scenario, which is the most severe of these. And you can see that in this scenario, if a recession were to start in the current quarter, we would expect that retail severe delinquencies for small retailers out West would increase over the next 2 years until 2020, where they would max out at about 1.4 percentage points. Then the magenta and pink lines show similar stories, but in slightly less severe scenarios. So that lower pink line shows a slower recovery scenario where the economy continues on a track similar, albeit slightly slower to the baseline. So we would expect delinquencies to sort of have bottomed out in the fourth quarter of 2017 and just sort of move vertically for the next year, year and a half before increasing slightly. And then in our moderate recession scenario, so again, a recession starting in the next quarter, we would expect that delinquencies would rise quickly for the next year, and in 2019, level out at around 1%, which is their historical, which is their max for what's shown in the data here. So I'm very excited that we're able to start bringing forecasts into the data, and the reason that we have this, and as you'll see in next quarter's report, is Experian has gone back and gotten additional data. So our data set has increased. So instead of going back to 2015, we now have historical data for small business credit by state, by industry, going back to mid-2012. So with those extra years of data, we're now able to forecast and get a better intuition for what is set to happen in the small business credit space. And with that, I'm going to turn things over to Brody.
Thanks, Derek. Really appreciate the small business forecast for retail delinquencies in the West, and I think it's a great step forward when we see these forecasts and can really look into the numbers to see where we could be with changes, both with the economic headwinds or tailwinds that we see out there in the market that you and Chris talked to, and see really where it could take us. Well, I want to take a little deeper dive, and we're going to look in this portion of the presentation into retail, and we're going to take it really starting at the consumer level, and from the consumer level we'll get into retail credit. So where I'll start is where Chris started this morning, and look at consumer confidence. And it really continues to rise. And this red line or pink line that you'll see in the middle is the average confidence measure for the time frame that we're showing, and has really been the hurdle to positive consumer confidence. So we've really made the leap here and are off and running on the positive side, trending up, which is great. And consumers' assessment of the current conditions, like Chris said up front, are upbeat, and it's due to that favorable labor market and the potential for wage growth. And if any of you have been in the hiring mode lately, you will have seen this firsthand. Well, when we think about consumers' confidence, it's driving our consumer retail originations. So these are, if you look at the trend here, it's very seasonal in the general trend, and it's been on the rise since 2011. Increased competition, price pressure that was mentioned earlier in some of the commentary, and other factors have kept this fairly flat over the past year or so. And in 2017, we saw balances, new balances, decline slightly. If you're in the Northeast right now in your fourth nor'easter, which Chris and I laughed a little bit about this morning, it probably doesn't help the numbers. But as we see this slight decrease, we'll talk about some of the positives upcoming that we're seeing in this retail market. We're going to start with consumer, though. So lenders have been pretty consistent in their retail credit offers in the space. So we use VantageScore to help visualize direct-to-consumer lender behavior, as it's a generic credit score, like FICO scores, that assess lending risk. Now, VantageScore has been trending up slightly, but not significant enough to say a tightening is coming for this consumer credit in this space. This is a positive trend from a consumer view because the access of credit to credit is not tightening. From a commercial perspective, consumers will still have the ability to inject that capital with their purchase activity into the retailer. So the credit is still open and available. Now, the number of consumer retail credit lines continues to trend in an upward direction, reaching about 209 million trades that we're finding on the Experian file. And we're still about 60 million, about 17% off of our pre-recession numbers. But the trend continues to chase that volume, really starting in 2017. Now, access to credit is open, so when we're seeing those trades increase and we're seeing that Vantage score stay pretty consistent. So in the retail space, so utilization trends that we're seeing here make sense, really because cards and lines don't need to be fully utilized. There's access to that credit still out there for consumers. Now this provides a higher availability of credit and open to buy when consumers are evaluating a potential purchase with a retailer. So the consumer retail credit sector is growing, but where's the rub? So let's talk about the rub. So consumer late-stage delinquencies can be, in some cases, a leading indicator of commercial retail performance. If consumers are not paying their bills, then retailers are challenged. And when reviewing these trend lines, the farther the lines diverge, so 60 to 89 on the bottom, 90 to 180 on top, the farther they diverge, the greater propensity to roll into a higher delinquency bucket. So this upward trend in higher delinquency rates could be a result of consistent delinquency trend over the past couple years in a sector where lines have been open and even dipping into slightly more risky consumer base. You know, Derek talked a little bit about that also. The increase in this later stage delinquency trend is something that you should be aware of because it means that consumers are not recovering as well. Now, we're not saying that they're not recovering or that the market is not good, but the trend here is that they're not recovering as well once they meet that later stage delinquency and get into the 60 to 89 bucket. So we're going to look at commercial credit here, and for our review of the commercial retail credit trends, we utilize the small business credit share data. So it's a consortium of data. Chris talked about it a bit, and Derek talked a little bit about it as well, and the ability to go back in time to review these trends. And what's in this consortium data is expanded payment performance data with product lines and credit card and loans and leases. So we'll use some of that information to dive a little deeper into the retail space. So as we transition here into commercial retail credit, we can see that new retail business openings have experienced some growth over the past 2 years. The growth has been in states where we've seen economic environment and natural disasters contribute to the development of new retail businesses. And even though we see a nice trend here in the addition of the new retail businesses to the sector, we've seen that this sector's growth has really been outpaced by all other commercial segments. So there are headwinds in the retail space. Brick and mortar establishments have really underestimated in the past couple years online retailers and are playing catch-up, a game of catch-up. So Amazon, Walmart, and others are really challenging both on price, and I saw a news article on return policies for different retailers, how they're challenging and how Amazon's really placed some pressure on them with the ease of the return. And so new entrants and established retailers really need to take a hard look at their business models as really consumer experience and convenience are beginning to outweigh price pressure. So I'll give you an example of this that I've seen. I was preparing for a trip and I went out and I bought a shirt online. So just a white button-down, regular plain shirt. I admit I'm not a very exciting guy. So I went out and I bought this shirt. I knew that the price was really higher online, and a store less than 5 miles away from my house had a lower price. But really, I found that the ease of the purchase experience and knowing that I could return the product easily outweighed the price difference. And I say this, and my wife sometimes will laugh at me when I say it'll cost me more in gas to go and buy it than to just buy it online. But for retailers, online is not the magic bullet. So we've seen some of the inverse and some mixing here, especially if you've been watching the news out there on retail online food delivery services. It's kind of the new frontier that people are trying to crack and find the best way to get into it. And we've seen Walmart in the news hiring hundreds of new personal shoppers. You've probably seen Blue Apron taking their online business and placing their meals into grocery stores, so trying a different business model to get a mix of price, consumer experience, and brand strength. And that's really, I think, what will determine the winners when we find that right mix. So I say all this really to make the point that commercial retail is evolving, and there will be challenges not only with tax policy and commodity prices that are impacting manufacturers and suppliers of the retail goods, but the business's ability to evolve their customer experience is going to play a big role in their success. So when we look at retailers opening lines of credit across the U.S., we see that it's a pretty stable trend. Now, you'll see some ups and downs here, but in general, it's a stable trend, and this is a good sign. In that credit remains open for businesses as they enter and really survive in this retail space. Now, we know retailers have access to credit, but how are they managing this debt? So we've seen stories in the news around big retailers struggling with Toys R Us right up front in the forefront. And, you know, as my family runs out to buy up some of these price-depressed toys and get some real deals, it has some impact really as a big story. So they're closing about 700 stores, the impact of thousands of jobs. But what I'll say is that it can partly be attributed to competition, to price discounts, and other online retailers like Walmart, Amazon, and Alibaba. So consumers, especially millennials, are comparison shopping and creating this pressure on these premium retailers. So, but in general, the retail story is positive. So delinquencies among commercial retail credit cards, you'll see that in the bottom left, have been steady with a decrease in the percent of charge-offs following a 90-day delinquency. They're decreasing. And as these grid lines converge, less businesses roll from that 90-plus into the derogatory status for their credit card accounts. Now, installment lines and lines of credit are even more of a positive story here for retailers as the charge-offs remain low and have even been on the decline. So when we look at these trends with a regional retail commercial credit lens, delinquency rates have been on the decline overall, with the Northeast having the largest decline in delinquent balances, and the South taking over that lowest delinquency position from the Western region. And this is part of what Chris talked about, that the West has really been slower to recover here. Now, across regions, the percentage of balances 90-plus days past due, there we go, has been on the decline, and charge-offs diverging in most cases to even lower level. So what is this telling us? It's telling us that even though the market is growing modestly in this retail space, it's maintaining and even improving its ability to manage debt. So what we need to be aware of are the potential headwinds. So consumers are taking on more debt compared to their income. The late-stage delinquency rates are beginning to trend upward just a bit, not much, just a bit. And U.S. and foreign policy changes that we've touched on today, rate increases that Chris mentioned, should be coming very shortly, increased prices of goods that could put additional pressure on the consumer and begin to place some additional pressure on their retail spending. So commercial retailers should be focusing on value and customer experience as they evolve. So what's important? What's important is the economy is continuing to grow, and Chris and Derek did a great job showing that through their forecasts that it still looks very positive for the next 12 and 24 months. Consumer and commercial confidence is high as it's been in quite a while. And in general, from what we've seen from the commercial credit data, is that retail businesses seem to be managing their debt well. Lenders haven't tightened the reins on commercial lending criteria. And I think what's important is that we'll continue to monitor the policy changes and economic drivers that impact this retail sector. So the retail sector is transforming itself to be more consumer-centric. And this growth market is buffering some of those growing pains, but we'll continue to watch it as it grows. So Gary, do we have any questions from our attendees? Anything that we can talk a little more to?
Yeah, there was one question that came in from Chris about commercial retail late-stage delinquency. He asks, why is West Virginia excluded from commercial retail late-stage delinquency? I think that was referring to some of your map slides. If we don't know the answer, though, we can get back to Chris after the webinar.
Let's come back to Chris on that. It should be included here, and we'll have to look a little deeper and see if we can answer that a little bit more, but it's in there.
Okay. All right, and then the slides, just a reminder, we will be sending a link out to everyone after the webinar. We showed a link at the beginning, so you should have that in just a moment, and I'll answer those questions that came through privately. So it doesn't look as if there were any other specific questions about today's content, but I do want to thank everybody for attending today's session. Thanks to Derek and Chris from Moody's Analytics, and of course to Brody from Experian for sharing all of this with us. When you close the webinar, folks, you'll be taken to a short event survey. We would greatly appreciate it if you could share your perceptions on today's webinar, and also look for that follow-up from us via email with information about the slides and where you can download those. If you would like further information on Moody's Analytics, you can go to moodysanalytics.com, and of course for business information services you can reach us at experian.com/B2B, and stay tuned for the Q1 report. That'll be next up for us for the Main Street report. We should see that early May, and looking for the team from Moody's and Experian to reconvene for the next quarterly business credit review. We hope you can join us on the next event. So thank you everybody for attending, and have a good day.